these conversations on our news stories and top stories that are happening in the business world at Smart24 TV. That is our handle. And of course, Instagram, Smart24_TV. So you can keep updated on the current state of affairs in the business world. Now, we are still looking at our top stories and seeing what is happening, what is making headlines in the East African space in terms of business. Now, Kenya seeks to dominate the supply of liquefied petroleum gas, that is LPG, by constructing the biggest import and storage gas facility in Mombasa and licensing more private companies to compete with Tanzania, which has dominated the business for years in the region. The announcement to construct a 25,000 ton storage facility by the Kenya Pipeline Company, that is KPC, which will connect to Kenya to the Kenya 42 Kenya shillings billion new Kipevu Oil Terminal 2, that is KOT, at the port of Mombasa. That comes a few days after Kenya banned imports of gas from Tanzania through the Namanga border. KPC has already, that is the Kenya Pipeline Company, has contracted a giant Pakistani firm, Petrochem Engineering Services, to design the LPG import and storage facility in Changamwe, that is Mombasa, as 5 private companies apply to tap into the new Kipevu Oil Terminal 2. The facility in Mombasa, once completed, will quicken the loading of cooking gas for distribution by trucks, which will help to cut demurrage costs. Of course, KPC says faster loading is expected to translate into lower prices of LPG, that is liquefied petroleum gas, by 30% once operational, as oil marketing companies pass the benefits of reduced demurrage costs to consumers. Now, the LPG storage capacity in Mombasa is limited to, and a huge demurrage is incurred by LPG ships, thus affecting the final consumer price of bottled gas. That read part of the Kenya Pipeline Company in tender documents. Now, Kenya Pipeline Company proposes to install, commission, and operate a 500 tons per day liquefied petroleum gas truck loading facility, which will enhance product evacuation and as such ease ullage constraints and subsequently reduce demurrage costs. Limited LPG gas storage capacity in Mombasa has meant that ships stay longer at the port, leading to higher demurrage costs, which are then transferred to consumers, thus paying high prices of bottled gas. Now, if you can remember, even gas here in our own country, that is LPG gas, has been increasing in price, given that even the smallest, one of the smallest cylinders, that is 8.6 kilograms, is currently trading at between 60 to 70,000, all the way from 57,000. So this maybe probably KPC company will help reduce the cost of gas in the country and in the region as well. Now, Kenya Pipeline Company currently receives imported liquefied petroleum gas from ships that are berthed at the Shimanzi Oil Company oil terminal and puts it into the tanks, that is the T610 and the T611, located within the Changamwe facility. The product is then evacuated to local terminals through interconnecting pipelines for truck loading and bottling respectively. Now, the lack of loading gantries for trucks loading has been a challenge to gas companies, and the facility, once complete, will allow companies to ferry in trucks, which has proved to be economically viable. With the completion of the KOT2, which with a capacity to connect different gas suppliers, the business, which has been controlled by a few companies, will end the monopoly, as already 5 companies have applied to connect to the terminal at the port of Mombasa. According to the National Environment Management Authority, NEMA, and the Energy Regulatory Authority, ERC, more than 5 companies have applied to get license from from the company to construct gas facilities. Some of the companies which have applied for the license to tap into the submerged gas pipeline from the KOT2 include the Avitas Company, Mombasa Gas Terminal Limited, Lionsgate Limited, Focus Container Freight Station, and the Mansa East Africa Limited. Once licensed, they will cater for untapped LPG market with the increasing population and demand in the country and in East Africa as the region. Kenya imports about 40% of the gas annually from Tanzanian liquefied petroleum gas farms via the Namanga and Holili border posts, and the remainder is imported through the port of Mombasa. The LPG cost in Mombasa is much higher than that in Dar es Salaam, as LPG in Dar es Salaam, because of the offloading and storage infrastructure at Dar es Salaam, our Tanga ports, is more efficient. Early this month, Kenya started crackdown on gas importers from Tanzania, as the country's revenue authority and of course Deputy Commissioner for Revenue and Regional Coordination, Mr. Joshua Kaguru, disclosed that the traders have been paying value-added tax, that is VAT, for 8% instead of 16%. Mr. Kaguru added that the traders are shipping the commodity from the Middle East and using the Namanga border point to pay lower taxes under the pretext they are sourcing it from Tanzania. With the opening crackdown, Kenya is now heavily relying on the new KOT2 jetty project owned by the Kenya Ports Authority, KPA, to open up the market and promote competition to increase LPG consumption and reduce the risks to citizens. The new KOT2 project includes a dedicated berth and pipeline of LPG, which will now allow for larger vessels to call at the port of Mombasa, promoting economies of scale and reducing handling costs drastically. Of course, this will also help Uganda, of course, which doesn't have any access to LPG except through the ports of Dar es Salaam and Mombasa, to probably lower the costs of LPG in the country, as we have seen a steady rise in the prices of gas in the country over the past couple of weeks, given the inflation already that is affecting the country, further increase in fuel prices and other commodities. I think this will be a good opportunity as well for Uganda to reduce its cost of gas and encourage cleaner cooking methods through using the liquefied petroleum gas. Another story making headlines in Tanzania here is that the company called ARM Cement has been selling its assets in Tanzania in order to raise funds that have paid all the claims of creditors in the market, and of course left a surplus of over 2.3 billion Kenya shillings, that is about $19.6 million that was transferred to Kenya. Locally, the funds were used in paying liabilities such as amounts owed to banks and investors in the firm's commercial paper. The firm's Tanzanian subsidiary, that is Maweni Limestone Limited, was sold by the administrators, PricewaterhouseCoopers, that is PwC, to a Chinese firm that is known as Hauxin Cement for over 11.9 billion Kenyan shillings, or 101.8 million US dollars. And the amount was more than enough to settle all the claims, totaling up to 8.7 billion Kenya shillings. And of course, due to Maweni's creditors, including 538 million Kenya shillings, which was due to the Tanzanian tax authority. Over 20 million US dollars was transferred to Kenya and added to the Kenya proceeds to pay the creditors, according to the administrators of the farm. Now, the Kenyan assets were sold to National Cement Company, owned by billionaire businessman Narendra Raval for 5 billion Kenya shillings. Despite the surplus cash from Maweni, Kenyan creditors suffered substantial losses in the liquidation of the cement manufacturer. And lenders and unsecured creditors lost over 11.5 billion Kenyan shillings in the process, while shareholders were completely wiped out. This is, of course, a very sad story for shareholders right there at the ARM cement factory, that after failing to pay its debts, remember, companies as they close, they always pay their creditors first. After paying their creditors, they also pay their employees, their salaries, and then the shareholders come last. And this time around, the shareholders actually were completely wiped out. Unsecured creditors who laid on aggregate claim of over 9 billion Kenya shillings on the farm took the biggest haircut after only recovering 6.2%, mainly banks such as Absa, Bank of Kenya, and of course UBA, United Bank of Africa, Bank Kenya, and of course were paid over 4.98 billion Kenya shillings out of their claims totaling up to 8.03 billion. Preferential creditors, which have priority in being paid in bankruptcies, were compensated in full at 326.6. And of course, the cement farm's debacle demonstrates the risks of sitting at the bottom of the payment waterfall, where a creditor is only compensated after claims from others have or higher up in the hierarchy have been settled. The biggest unsecured lenders included holders of the ARM's commercial paper and of course bonds that are worth over 1.82 billion Kenyan shillings. Private lender Eros, of course, at 1.55 billion Kenyan shillings, and of course Stanbic Bank at 920.1 million Kenyan shillings. The cement makers' former employees were also owed salary arrears worth 30 million Kenya shillings. ARM's financial difficulties saw it placed in administration in August 2018 after, of course, failing to serve bank loans as losses piled up and ate into its capital, with the principal shareholders, including the Paunrama family and UK's Sovereign Wealth Fund, CDC Group, falling to inject new capital to ease the problem. It had racked up over 14 billion Kenya shillings in debt and had a negative equity of 2.4 billion Kenya shillings at the time. The move into administration ushered out its long-serving chief executive, Pradeep Paunrama, whose family founded the company in 1974. That is a very sad story for a company there that was, of course, making cement, but due to financial difficulties, it ran into bankruptcy. And running into bankruptcy would mean closing business and selling assets in order to finance, debts and loans and all the other things. And of course, shareholders in the company made huge losses right there in ARM Cement Company that is in Tanzania. Of course, this is one of the sad stories that we can learn from here as the financial markets team, that always business doesn't go well. It's not a Sunday every day on the market. If a company faces problems and difficulties and has to go bankrupt or sell assets in order to finance its debt, you as a shareholder usually are the last person to be paid unless policies state otherwise. So that is something to learn from there from ARM, cement company in Tanzania, that anything could happen on the stock market and it's a risky venture. But as well, that doesn't stop us as enthusiasts in the financial markets to keep investing and making moves. Our final story of this hour the East African states have rushed to impose new taxes on imported goods. Now, following the May 5th decision by the East African Community finance ministers to adopt a 35% rate for the fourth band of region's common external tariffs, that is the CET, member countries are working to identify, review, and impose new taxes on imported goods to protect local industries. The new tax, whose implementation starts on July 1st, will affect commodities such as iron, steel, dairy, and meat products, and other affected imported goods, cereals, cotton, textiles, edible oils and beverages, and of course spirits. The CET's 4 brands include one for raw materials, which affects 0% tax, intermediate goods that attract over 10% tax, and secondary intermediate goods charged at 25% tax, and finished goods. The fourth band, which now stands at 35%. The process of identifying which products fall in the fourth band is now complete, and most of the products under this band are readily available in the region, and therefore will attract more tax to import. And of course, that is according to Miss Betty Maina, Kenya's Cabinet Secretary for Trade and Industrialization and Enterprise Development. Finished goods that cannot be produced in the region have been allocated in the third band, as she said there. Now, tariff lines referred to as customs duties on merchandise imports provide price advantage to locally produced goods over similar goods that are imported from other foreign countries. Among the tariff lines in the fourth band are furniture, leather products, fresh cut flowers, fruits and nuts, sugar and confectionery, coffee, tea and spices, textiles, ceramics, and of course paints. The maximum tariff band at 35% was considered as it has the most positive impact on the regional growth long term. Now, the 35% tariff significantly eliminates the use of stays of applications, that is SOAs, since some of the East African Community partner states are currently applying 35% tariff rates on over 50% of those products that qualify for the fourth tariff band. Ms. Maina, who is the chairperson of the East African Council of Ministers, said that in their meeting right there. In its application, a welfare loss is expected that would be cured by generated added employment opportunities from the switch to local production. Uganda, Kenya, and Tanzania are the most affected following the determination of the maximum CET tariff rate for fourth band products at over 35%. Indeed, Uganda has called upon the region to impose duty on finished iron and steel products to grow the iron and ore industry in the country. The implementation of the reviewed East African Community CET starts from 1st of July 2022. It shall be applied flexibly, particularly on products affected by the prevailing economic situations. That is according to Mr. Wakiga, the CEO of Kenya Association of Manufacturers, that is KAM. We will be following up on this story as we see inflation and weakening of the shillings. We are seeing that countries in East Africa are looking at imposing higher taxes on several goods that are imported, but could actually be, affected. That could actually be produced here, in the country. So if we impose more taxes, we will be regulating those imports and probably promoting our local, productions here in the country. We'll be following up with more of that story and more. But now, our time is fast spent. We are going to, talk to Mr. Ojwang Peter, who is a digital, marketing expert, to talk to us about what's happening in the digital marketing space and what are the pros and cons How can we control cybercrime? How can we still, use digital assets safely without, involving ourselves in cybercrime? We'll be right back. Don't go anywhere. My name is Anthony. This is Financial Markets.